Okay, got it.
Thanks, Jim.
Sure.
So again, for those of you who don't know me and the Predistribution Initiative, for those of you who are just joining, my name is Delilah Rothenberg. I'm the founder and executive director of the Predistribution Initiative. We are a multi-stakeholder project designed to co-create improved investment structures and practices that share more wealth and influence with workers and communities, that have stronger incentives for investment teams to integrate ESG, and that ultimately address systemic and systematic risks, including inequality and climate change. This is the second webinar in a series that we're doing around our working paper that we just published, ESG 2.0, Investor Risks Beyond the Enterprise Level. The paper is quite vast and covers a lot of different topics. So this webinar series is designed to allow us to do deep dives into various topics that are particularly important in the paper. And I don't know if I just mentioned it, but we'll put a link to the paper in the chat so that you can check it out if you haven't already. Our next webinar will be with economist Karen Petro on her book, Engine of Inequality, the Fed and the Future of Wealth in America. Our chief economist and one of our founding team members, Raphael Schaap, will be leading that webinar. The date will be May 24th, the time 3 p.m. Eastern, and registration details forthcoming. Please keep an eye out for an email and LinkedIn posts about that. So today, we're going to be focusing on the book, Moving Beyond Modern Portfolio Theory, Investing That Matters, by our guest speakers, John Lukomnik and Jim Hawley. I received my book over the weekend and rushed through it in time for the webinar today. And for those of you who don't have it, we'll also put a link in the chat to the book so that you can purchase it. I did have the pleasure of reading one of the chapters early on that focused on materiality, as well as being familiar with Jim and John's work from before. And John, I'm not sure if you actually know this, but we ran into each other probably in 2016 or 2017 at a Council of Institutional Investors conference, where you were promoting your previous book that you co-authored, What They Do With Your Money. And I found it very interesting. And then I stumbled across a webinar that you and Jim did in mid-2019 on breathing new life into modern portfolio theory. And that it was a podcast. And the podcast was with the Principles for Responsible Investment. And it really left an impact on me because I was working in private equity at the time and thinking about how certain activities of our portfolio companies were exacerbating economic inequality, which could cause risks to our investors' portfolios, even if those activities did not cause actual financial material risks, that we were in a position to measure and manage at the fund, with our fund, and in the context of existing interpretations of financial materiality. And so the podcast really provided a framework and helped validate some of the concerns that I had about the way we were thinking about risk. And then later on, when John, we ran into each other at an investment integration project meeting. And for those of you who aren't familiar with the Investment Integration Project, it's another wonderful organization. Highly recommend you check them out. But we ran into each other at that meeting, and I learned that John and Jim were working on follow-on work from that podcast and this book. And really, this book is so important to the work that we're doing at the Predistribution Initiative because it acknowledges that investors and investment structures and practices can have impacts on markets, and that there's this feedback loop, and investors can choose to use their power and influence to mitigate and manage those risks or contribute to them. And there doesn't seem to be a lot of knowledge about these dynamics. And so I'm really grateful to the leadership that Jim and John are providing on this topic. And I think that's enough of a teaser of what the content of the book covers. So I think I'll hand it over to Jim now, who's going to lead us through the first part of the presentation, and then we'll go to John, and then we'll do a bit of moderated Q&A, and then audience Q&A. So
good. Thank you much, Delilah, for those kind words and very, I think, useful introduction and context. I'm going to share my screen, so give me a minute here. I think this should be good. Yes? Okay. As Delilah said, we have written this book, Moving Beyond Modern Portfolio Theory, Investing That Matters. We wrote the book not as a modest book. Our intention is essentially to entirely redefine what investing is, its parameters, how it's done, and in a sense, reorient towards a different true north. And so what we'd like to do is briefly run through some of the highlights of the book. MPT was a revolution conceptually and technically. There's a picture of Cervantes's Don Quixote here, and at least as far as we could tell, the notion of don't put all your eggs in one basket, that is diversification, at least in the West, goes back to Don Quixote. So it's not new, but nevertheless, the notion, as I'm sure you all are familiar with, of the efficient frontier, which is on the right side, is something that was developed by Harry Markowitz in terms of the technical math behind it. And essentially what you have is if each dot is a portfolio, the closest to the efficient frontier, which is that sort of inverted Nike swoosh looking thing here, is where you get the greatest return with the lowest degree of risk. So you have expected return on the horizontal and risk as measured by the standard deviation of volatility on the expected risk on the vertical and expected volatility on the horizontal. So that's a quick sense of it was a revolution. Like most revolutions, they have consequence, and many of the consequences, of course, are unforeseen. But in terms of finance, clearly what it meant is that MPT, especially as it began to really take hold in the 70s and 80s, even though Markowitz's first article was in 1952, for which he won the Nobel Prize, that essentially it turbocharged the institutionalization of assets and the asset management industry, mutual funds in particular. So that when Markowitz wrote fully 92% in the US of retail of investment was retail, and today that number is almost completely reversed. We'll go into why we think this has huge significance in terms of MPT in particular. And MPT obviously lays the intellectual groundwork and some of the technical means to run efficient index funds. Clearly, it has legal implications as well, because MPT diversification in a pre-MPT form, in fact, was written in the 1940 Act in the US. But as trust law developed, as the ending of the state legal lists in terms of what state pension funds could invest in the 70s, 80s, and 90s, was essentially due to MPT kind of thinking. So it's had very widespread implications. There are a number of enabling theories which actually come out of neoclassical economics, at least two or perhaps three of them, that are enabling theories of MPT. The first one is rationality, the Homo economicus, the notion of, quote, economic man, unquote, that rationality is critical, that everything is calculating and calculated. That second enabling theory is the random walk, which I'm sure people are very familiar with very quickly, that one event is not dependent on the next, very much like a coin flip. Heads on one flip is not dependent on either heads or tails previously. And that the efficient market hypothesis is the third enabling theory in a variety of its forms, the soft, hard, and sort of intermediate form, that essentially markets clear, that if there is inefficiency built in, various forms of arbitrage very quickly make it efficient again. And obviously there's been huge amount of discussion literature on this. It's been highly criticized. In fact, all of these have been highly criticized. But MPT, in a certain way, pulls these in and pulls them in very uncritically. And when I say MPT, I'm not just talking about Harry Markowitz's own work, but sort of the whole MPT tradition, which in the book we discuss at some length. So in a sense, we argue that it creates a perfect myth. It's easy to understand. It is powerful. It is powerful in its explanatory techniques. And we suggest it's also wrong for a number of reasons. So for example, just to focus on the assumption of rational human beings, on the left, we have the gray rational human being. And we have, of course, the human being that has increasingly been, at least in the economics and financial traditions, rediscovered. It never went away, which is to say that that emotion is hugely important. Everything is not rational. And so that rationality for Markowitz and in general for this tradition has led to the notion of being risk averse. And prospect theory, which is Kahneman and Tversky, they too, or at least Kahneman, got a Nobel Prize. And the notion, for example, for prospect theory is that it's loss averse. And that's a very, very different, leads to very, very different implications in terms of, for example, behavior, and that has implications for risk. In terms of the random walk, and this is the famous cartoon where the drunk has lost his keys and is walking in somewhat random ways under the street light, because of course that's where you can see the keys. Of course, they may not have been lost at the street light, and that is partially our point. So that random walk is to a large extent vitiated by path dependency. So momentum strategies would be one example of that, though there are many. Loss aversion, which is also a type of path dependency, and financial contagion or financial intersectionality. The 2008 crisis was, of course, the most recent huge example of that, though there are many others. So again, another cartoon which is often used to in conjunction with the efficient market hypothesis is a couple is walking by. There's a dollar bill or a $10 or a $20 bill on the street, and they didn't pick it up, which of course the efficient market hypothesis would suggest they should. So because you can't leave a bill on the street. It doesn't make sense. Somebody would have picked it up. So the notion is they believed in it and therefore didn't pick it up. So the efficient market hypothesis has extraordinarily weak logic in our point of view, from our point of view, and that's along with lots of others, and weaker evidence. So for example, in terms of information, there are huge inefficiencies that are widely written about. It assumes, that is, efficient market hypothesis assumes price takers. It doesn't have an adequate explanation for arbitrage. And it would imply, and some people explicitly have run with this, that there's no need, for example, for insider trading laws. But if information flowed, that's really inadequate. And in a sense, there is a widely developed social science of information, all of which MPT, and in my view, in general, traditional neoclassical economics ignores. That is, information is not adequate. Information has to lead to knowledge. That is, there's some ability to sort through what is useful and relevant information for a particular purpose. And knowledge has to lead to comprehension, and comprehension to action. That's a complex human sets of development. And it's not, you still have that even with the most highly developed computer trading, because obviously the algorithms at root are written by people. And so that this process is very, very complex, and it is anything but efficient. So our basic point is that MPT is hermetically sealed, or at least has become hermetically sealed in its math, and it is divorced from the real world, and it assumes away links to the real world. And so there's a disconnect which is broader than MPT, and again, especially since the 08 crisis has been written about and discussed a lot, but a disconnect between markets and the economy. So that for MPT, volatility has become the dominant measure of risk. And diversification is the single tool, not an unimportant one, but the single tool that mitigates that risk as measured by volatility. The causes of volatility are simply not relevant to the MPT construct, which in some ways is remarkably naive when you think about it. And it's not that people aren't concerned with causes of volatility, but it's simply not relevant to both the theory and the dominant practice of how MPT is used in terms of portfolio construction, design, and evaluation. And so it begins, or is itself, a tool in the divorce of financial markets from the real economy. And that is just, from our point of view, hugely important, so that MPT is an artificial and nearly singular among financial economic theories in viewing investing as separate from the world of value creation. This is a very odd group of five economists, two of whom did not win the Nobel Prize. They had the unfortunate cause of being born too early. So we see Adam Smith and Karl Marx at the top left. At the bottom, we see Milton Friedman, and we see Oliver Williamson and Coase at the sides. And what all of these have in common, aside from that the three modern ones all won Nobel Prizes, is that they're each in their own and in some ways radically different ways connect finance to the real economy. And in that sense, MPT stands in a huge disjunction. And in the book, we go through each of these five and talk about how they are very different from each other, but there are certain commonalities in spite of the fact that people think in some ways there are huge differences here. So that each in his own way talks about how economic theory relates to the larger socio-economic world. One of the main points that we try to make in the book is what we call the MPT paradox. And very quickly, it's a one-way valve or a one-way street. And the notion is that markets affect your investments, but your investments don't have impact on the market, which, if you think about it, is on its face somewhat bizarre, given that in investing in firms have actions directly or indirectly have feedback loops, but MPT doesn't build in feedback loops. And so, as one, probably the most important, depending on the particular studies you look at, but I think the general sense is between 75 and 94% of return has to do with systematic factors, whereas MPT ends up focusing on what matters least, given that range from 75 to 94%. And MPT therefore focuses on trading, portfolio construction, and risk as measured by volatility, rather than on the systematic and systemic issues. And when we say systemic, we're talking about issues such as climate, such as gender inequality. Those would be systemic issues which create systematic risk, which is to say risk for the portfolio as a whole. So MPT is self-referential. It focuses on extracting returns from a market at a particular point in time. It is not concerned except with its assumptions to say that, well, the purpose of investing is to save, right? Or for whatever, is to grow wealth. But it's not focused on the specifics of what that means. And we will go into that when John takes over. For example, retirement, college, vacation, day-to-day needs, and so on. Its returns are entirely relative returns, and benchmarks are therefore entirely relative and self-referential. That's hugely important. And again, in the book, we try to develop that at some length in terms of what the logic of relative returns and benchmarking based on relative returns is. And the obvious case here is if a portfolio manager outperforms by, say, 200 basis points in a down market of, say, 10%, clearly what you have is outperformance. But on the other hand, you still have only 92 cents on the dollar left. And if you're savings or trying to grow wealth for real purposes, it's that 92 cents, which at the end of the day counts, because that is the market as a whole. The notion here, and I purposely use the term all investments have impact. Impact investment, in my view, is a term which is hugely important. It means many, many things to many people, but it's important to step back and say every investment has impact. They can be unintentional, risk on, risk off markets, index effects, super portfolios. So the notion is that investments have systematic risk that has impact that again feeds back. Markowitz's writings, including many of his later writings, did not see this. In 1952, indeed, right up into the 1970s, as I mentioned, majority of investment is retail, and today it's overwhelmingly in the US and globally institutional, and that has huge import. And John is going to take over from here, and I'm going to go to the next slide.
Thank you, Jim, and thank you, Delilah, and the Predistribution Initiative for sponsoring this. Just to elucidate a little bit more on why Markowitz didn't see it, we sometimes jokingly refer to something called the Gravity Conundrum. If I walk across the room, then I have an effect on the gravitational pull of the moon. But unless you're a theoretical astrophysicist, you don't care because you can't see it, you can't measure it, and in reality, someone else is probably walking across the room in a different direction at the same time, and that was the market that Markowitz saw. That is not the market we're in today, and that has all sorts of impacts, including to materiality. So the Supreme Court definition of materiality is that which a reasonable investor would consider. The problem is it gets frozen in time. People think about a reasonable investor as some individual poring over financial statements the way they would have in Markowitz's time. Now, clearly, social and ethical norms change. Slavery was a material part of capitalism in the 1830s. It was the single largest collateral for the British loan market. Unethical then, but it was not illegal, and it was what was considered at the time, and clearly we don't do it now. But it's not just social and ethical norms changing, but scientific knowledge changes. The obvious example is climate change. But we also know about pollution, groundwater pollution, air pollution. We know about the links between tobacco and cancer or certain foods and obesity. And reasonable investors probably want to consider new scientific knowledge as they judge what is material. The other thing that's changed, as Jim said, is everyone's institutionalized today. Many of the people in the audience represent either asset owners or asset managers. Very few people have a portfolio of 2 companies. People are diversified. They buy the S&P 500 or the aggregate bond market or the global indices. And so you are no longer necessarily concerned with the results only in a particular company, or what we call outside-in materiality. What is the world doing to my company? But you're concerned with what the company does to the overall market because of this 75 to 94% of the variability of returns being affected by these systematic issues. Now, right now, the European Union is considering definitions of materiality, and it tries to have it both ways by considering dual materiality, outside-in materiality, and what we have come to call inside-out materiality. What is the company doing to the marketplace? This is just an example of it. This is from the non-financial reporting directive that the EU has put out. They, in some ways, break out consumers, civil society employees, and investors from just investors. We actually think, for reasons that we'll get into in what we call extended risk and extended materiality, that that's a useful but somewhat oversimplifying and artificial distinction. So if you think about the purposes of asset management, risk mitigation or creating an optimal or better risk return profile for an investor, and intermediation, or as the third Lord Rothschild said, taking money from point A in the world where it is to point B where it is needed in hopefully a societal useful way. And then you bring in time, because MPT is nothing if not a point in time dynamic. It doesn't consider feedback loops, so why should it consider feedback loops over time? But when you add feedback loops and you add time, you get something very interesting. We call it extended risk and extended intermediation. So if I am saving for retirement, I know there are a number of pension fund investors on this call, then the fruits of that investment, the cash flows in the future, are going to be expended at a different time and with a different condition of life. And it is very difficult to put a present value discount on that. For instance, if I have to live inside a gated community because of social unrest, or even worse, live outside a gated community looking in because of conditions of social unrest, how do you put a discount rate on that? If I no longer have a seashore, if there's no biodiversity, how do I put a cost on that? Now, some things you can put costs on. Health effects, the UK government estimates that antimicrobial resistance left untreated will cost $100 trillion by 2050 and kill 10 million people unnecessarily. And it's interesting that there are a number of investors, Nordea Bank, Shareholder Commons, and a number of others who are now trying to address antimicrobial resistance. But MPT doesn't discount or think about it because it doesn't deal with these issues. And the obvious other answer here is fossil fuel. Thankfully, some of the accounting standard setters in Europe, at least, are now forcing people to figure out if you have said that you've taken a 2050 net zero pledge, then you can't have assets that you think have values past 2050. Unfortunately, the US hasn't quite reached that level of logic yet, but we will get there. Next. Time horizons are an interesting thing. We tend to be we hyper discount future cash flows, and that results in suboptimal intermediation. Andy Haldane, the chief economist at the Bank of England, says it is a public policy crisis because the very things which have the largest impact positively for society have the greatest hyper discounting, basic R&D, infrastructure, and things like that. We also hyper discount the negatives, and so we don't rationally consider carbon's impact on future values. So what are investors doing? I'm not going to go through what we call beta activist campaigns. You all know about climate change and people fighting for gender diversity and income inequality. What I do want to talk about, though, is that when we say beta activists, we are talking about campaigns that try to change the real world systemic risks before they metastasize into systematic risks in the capital markets. And the difference between this and traditional activism is that we look at systems, so climate change, the environmental system, gender diversity, or racial and ethnic diversity, the social systems, and at industries. So for instance, the AMR and food chain and pharmaceuticals, mining safety, they're not geared as much at specific companies, because if you are a large diversified investor, you care about the systematic risk to the marketplace. Next slide, please. You can combine this. You know what, I'm going to skip this just in the interest of time because I know we're running late. But basically, most third stage corporate governance tools work atop MPT. We are not throwing out diversification. Even when you divest, you don't throw out diversification. If anyone wants, we'll provide the slides afterwards and explain why. But this is really the heart of the issue and what investors are doing. MPT tries to deal with idiosyncratic risk through diversification in the capital markets. Beta activism tries to deal with systematic risk, the non-diversifiable risk that swamps diversifiable risk in terms of impact. Its risk technique is to engage in the real world. And the goal is to improve the overall market risk, market return. Think of it this way: if the overall market were a portfolio, how do you improve the Sharpe ratio of the overall market? Because then if you apply MPT as a means of extracting the best possible portfolio, you're starting from a higher base, and that lifts all boats. It also has obviously salutary effects for society and the economy. There are, and I'm sure everyone on this call knows them, more than 100 current beta activist campaigns. In fact, I was amused that the London Stock Exchange about a month ago put out a guide to climate change for investors, and the very first page said something along the lines of, there are so many climate campaigns that it may be a little confusing, before going on and trying to provide some clarity to that confusion. Next. So how does this work? It is difficult in terms of economics. It's difficult to precisely estimate. There are some really good examples. The New York City Comptroller's Boardroom Accountability Project was studied by 3 Economists and found that it added 53 basis points in excess return. You project that across the then extant US public markets, and it could have, were it adopted across the full market, added about $130 billion to market value. There are, as I said, estimates on antimicrobial resistance. McKinsey has done work on gender diversity, and we looked at over 100 studies. And our best estimate is that the actions already taken have added about $2 to $5 trillion to market value. Now, that is non-differentiated for asset management firms. We get asked about free riding all the time. But just because it's not differentiated doesn't mean it's not real for beneficiaries, real for the economy, and real for the actual purpose of asset management, as opposed to for the asset management industry. But I will say, and we have a formula in the book as to how asset management firms should think about this as, in effect, a cheap insurance policy. Since asset management firms do charge asset-based fees, it's still a 2 to 5% revenue boost for asset management firms. And thankfully, we are starting to see some asset management firms try to compete based on their third stage corporate governance activities like stewardship. But in the end, that really is not the point. Finance is a service industry. It is there to serve the real economy, there to serve society. The dollars are just the marker of part of it. And as my previous co-author and social entrepreneur, David Pitt Watson, said, activism is there to ensure the proper use of entrusted power. Without it and its complements, capital markets will fail. Or as corporate governance planner Bob Monk said more succinctly, capitalism without owners will fail. And so in some ways, this is, in a capitalist society, people with capital acting the way they should act, engaging with society, with the real economy, and no longer being content to have hermetically sealed math where you deal with part of the market and you don't deal with all of the market. And if you're going to deal with all of the market, you have to deal with society. With that, we will stop and take questions.
So thank you so much, John and Jim. That was an amazing presentation. And, you know, recognizing we only have 20 minutes left, I have a lot of questions, but I think I'm just going to focus on one to start so that we make sure this is a big audience. I'm sure there are a lot of questions among participants. As I mentioned, one of the reasons why the book is so interesting to the Predistribution Initiative is because it acknowledges that market structure can have impacts itself. And so at various points in the book, you know, in this presentation, you've talked about the institutionalization of capital. In our paper, ESG 2.0, we raise some concerns about the institutionalization of capital in terms of the consolidation of capital flows, potentially leading to consolidation among asset managers and potentially corporate consolidation as well. And I think in the book, you use some examples about concerns that others have about index funds and how they can lead to price distortions and co-movement and a sort of de facto momentum style of trading that can magnify the divide between real markets, the real economy and markets. And so, you know, curious, there's a lot of interest and there's a lot of recognition that what you talk about in the book can be applied to how investors manage their portfolio companies. But for large institutional asset owners and allocators, are there things that they can do to also help improve market structure and think about deconsolidating capital flows and address some of these other systematic risks that seem to be present that don't have to do so much with corporate operations?
Yeah, let me start with that. I think we're in the early innings of people thinking about what an index fund really means. Traditionally, they have been capitalization weighted, or free float capitalization weighted, replications of entire markets. They need not be, right? Rob Barnott has talked about weighting things according to the real economy, whether it's revenues or employees or balance sheets or whatever. Secondly, people are now deconstructing indices all over the place, whether it's low carbon indices or you can buy an index that is about the cyber initiative economy, or an index that's about junior gold miners, or an index that's about, you name it. I can probably find an index for you. In fact, there are actually more indices in the world than there are individual securities, which is a pretty amazing statement. And so one of the things that I think is happening is that people are understanding that with so much of your return being linked to factors, the smart beta or factors, whatever, that your choice of index is in effect the new active management, right? And I'm hopeful that the issue that you state will, for instance, index effects and floating up and away in super portfolios, will somewhat cure itself as large institutions become more sophisticated in their choice of indices, because that will naturally dampen those index inclusion and super portfolio effects for all but the very largest stocks. I would also point out that there are some advantages to the institutionalization of capital. We go through the stages of corporate governance, and for 350 years, basically, you had rent-seeking by executives. I mean, starting back from the Dutch East India Corporation that, basically decided not to pay dividends and pay them in nutmeg, up to the entrenched CEOs of the 1980s. And one of the underlying enablers of the modern corporate governance and sustainability movements is that investors became large enough to take on corporations. And so I don't know what the optimal size or the optimal number is, but those are my two reflections. One backward, that you need some amount of size to take on corporate behavior, and one looking forward, that I think that we will see a fracturing of index funds away from the assumption of market efficiency, which Jim spoke about, which is what drives capitalization weighted indices.
Thanks, John. Jim, anything to add, or?
No, I have nothing to add, but let's get to some other questions, and we can perhaps, if this circles back to that, that's fine.
Absolutely. So I see that Daniel Fuentes has his hand up. So Daniel, do you want to unmute yourself?
Yes, can you hear me?
Hi, yes.
Hi, yeah, thank you. Thanks so much for this presentation. Big fan of your work, and also a big fan of the idea of nominating you for the Nobel Prize. That's count on me for that, +1. So in this beautiful book that's called, not yours, but another one called Chains of Finance, the authors talk about how the investment chain is composed of so many actors. So from savers, including companies, charities, individuals, governments, to fundraisers, to investment consultants, to investment management firms, investment banks, the market, government companies, etc., etc. They describe the investment chain as so complex and composed of so many actors that precisely because of that complexity, and precisely because of the vast majority of the large number of actors, it's very difficult, almost impossible, to actually have an impact on the investment chain. So the question that I have is, in the research you conducted, I'm curious if you identified 1 or 2 or 3 or 5 actors of the investment chain, who, from your perspective, actually got what you are promoting, or on which we could have the most influence. And by we, I mean all of us. I'm curious to see if there's in this investment chain, which would be the link where you believe we could actually have the most impact to advance this conversation. Thank you.
Thanks, Daniel. Jim, it looks like
That,
you're about to.
yeah, I'm thinking about it. It's a good question, and I think it's a complex question, and I think it also varies jurisdiction to jurisdiction, because the structures and legal structures are often different. My sense is, at the end of the day, what holds the investment chain together are incentives. And a lot of the incentives of that complex chain, or maybe a simpler chain, are perverse, given what I think we're arguing. And so incentives need to be very significantly redone. That doesn't solve all problems, but it begins to put it in some light. And that goes back, I think, to the point I made about relative benchmarking, that if benchmarking becomes the key element of incentives throughout the chain, and it's all based on relative performance, that's perverse. So that there has to be some links. And I think there's some developments here that are significant. The World Benchmarking Alliance is attempting, and as are others, to say what are real social, economic, political relevant benchmarks. And if you begin to move in that direction, I'm not sure you'll simplify the chain. I think that's probably inevitable, but I think it may work somewhat differently.
Yeah. Incentives definitely matter. Delilah, you mentioned that you had read the previous book, What They Do With Your Money. I thought the question was leading directly to that. So Daniel, we actually deal with this a lot, that book. There's an average of 17 intermediaries between point A and point B in putting money to work. One of the perverse incentives that's going on is the micro efficiencies between them has actually gotten better. You can move money quicker and less expensively and stuff, but the chain has grown larger. And so there's an NYU economist, Daniel Philippon, who has looked at this and said, basically from the 1890s, I apologize, someone's banging next door, from the age of the railway till now, actually finance has not gotten more efficient. It costs the same amount, about 2%, to intermediate a dollar as it did then. Now, if you think about the efficiency growth in technology in almost any other field, the fact that you can go 125 years without an efficiency gain and still and increase your percentage of the real economy that flows through your sector is pretty amazing. To answer your question, I do think we can make an impact. We detail in this book a number of impacts that have been made, and I will just say that Todd Gormley, who's another professor, right now has a paper out talking about the impact of investors on gender diversity, even when you control for the Me Too movement and for the California state law. And he finds that investors have greatly added, the investor pressure has added to gender diversity. My last point on where in the chain you should look, banks and insurance companies. If you can't insure a coal-fired plant, if you can't insure a manufacturing facility, you can't open it. And so if you're looking for leverage points, that's where it is. And Share Action in the UK, for instance, just cut a deal. They'd like to cut a better deal, but they just cut a deal with HSBC about exactly that issue. And I know that Allianz Global has now refused to insure thermal coal and a bunch of other things. So those are two leverage points if you're looking for it.
Thanks, John and Jim. So given that we only have a little bit of time left, I want to make sure that each of the folks who want to ask a question can ask the question. And then John and Jim, perhaps you can try to answer all three questions very quickly. So to start, Anne Cabot, and I can't see the rest of your last name anymore, Anne, I'm sorry. Are you suggesting that if we create better benchmarks, bring on better corporate data, and open up the universe of investing to listed and unlisted investment, we can evolve MPT to a risk return impact optimization framework? Or is it not as simple as that? Or do we have to completely rethink the model? So that's one question. Scott had his hand up prior to that, and then Damon also has his hand up. So Scott, do you want to very quickly ask your question, and then Damon very quickly, and we'll try to answer everything all at once.
Very challenging. First, you guys, so glad you've tackled this. I pre-ordered your book. I was so glad to get it, and I really think we need to have another session. It's just there's too much to cover here in such a short period of time. I mean, it's amazing to me that this is a 60-year-old theory which is still controlling markets, and so much has changed since then, as you point out. But one of the questions I have is, what is the question for asset owners, the big the institutions controlling this stuff, that you're seeking to answer? Are you trying to, what is it you want them to do as a result of these findings? Change how they define risk? Is it, how do you want them to change their asset allocation models? And is it the question that you're saying to them, look, guys, you need to think about risk differently because it impacts performance? I mean, are you seeking to back up that argument, which is an argument we make all the time in our impact investing, that it's in their interest to do this? But what I want to know specifically, what you're really driving at to really make system change here through the asset owner side. Thank you.
Thanks, Scott. And Damon.
Yeah. So maybe this is the variant on other people's questions, but I wanted to understand, sort of moving past the notion that, yes, if you impact the real world, you impact your portfolios, which is kind of the motive behind investor behind activism, to the question of the question of how would you, are we arguing that proposition is not contradictory with modern portfolio theory or efficient markets hypothesis? They don't, those things aren't actually at odds. I want to understand more clearly from our speakers, what change would they make, not in activism practice, but in investing practice, A, and B, if there's time, which it probably isn't, what is among the largest impacts in terms of that's out there in terms of affecting the macroeconomy over the last 30 years globally is rising inequality. And I'm curious what the groups, our speakers' view is of the long-term impact of rising investor activism on income inequality.
Thanks, Damon. Great questions from our audience.
Are we ready to take a crack very quickly? Okay, I'm not going to take them in order, and I'm not going to answer them all. Hopefully John can answer the ones that I'm not going to. But starting with Damon's last question in terms of, and I think it's related, the issue of income inequality and generally economic insecurity is, in my mind, directly related to a number of elements of macroeconomic risk. Macroeconomic risk does not directly manifest in volatility, essentially, until it's too late. That is, when some sector has a debt crisis, for example, all of a sudden you get volatility. So the issue of what investment means, to go to the next question, is this may have implications just like climate and issues of disinvestment or divestment from fossil fuels, or coal in particular. How you value that is, I think, directly related to investing. It doesn't in and of itself say, depending on what you consider the essence of MPT, which is diversification and certain techniques for measuring efficient frontiers and risk and so on. It broadens that, however, and in broadening it, it makes you less reliant on a single metric of risk. And there's, I think, reasonable people disagree on what that might be. And I think that is, in fact, in practice, often developing. So it's not that we're throwing out MPT, but it does get significantly changed when you bring in other metrics of risk in particular. And I think these would be an example of that. Let me hold off on the others. Pass it to John and see what he has to say. John, you're mute.
In some ways, I do think what we're suggesting is a bit at odds with certainly MPT as it's practiced. And, Damon, you and I have a long history of believing that you deal with the real world. But there are a lot of people out there who say this is politicization, this is preferences. And I think that what we are bringing to the table is the first coherent finance theory that says, no, this is actually going back to apartheid, to the series principles, to whatever, sequential attempts to mitigate non-diversifiable risk, which is the fundamental purpose of professional investing. And so in terms of what I want people to do differently, which also gets to Scott's question, and I'll get to income inequality in a second, if you are redefining investing to care about the overall risk return of the marketplace itself, it causes a real re-examination of everything from who you're paying. Why does a great stewardship person get paid less than a mediocre portfolio manager? Mike Garland at the New York City Comptroller's Office, who basically ran the Boardroom Accountability Project, created $5 million in immediate value for New York City, $26 million in immediate value for New York City, and something like $132 billion of value for the U.S. capital markets. That's a lot more impressive than whoever your star portfolio manager or hedge fund person is. Why do you resource the way you do? Why do you compete for assets based on relative value benchmarking, as opposed to, particularly if you're an index fund, low cost indexation and high impact stewardship activities? How do you make sure that the political regulations understand that as a diversified investor, all this is important, not just for social reasons, but for purely financial reasons? So I do think that this is somewhat at odds with the way that at least part of the world has interpreted what is, quote, legitimate investing per se. For instance, the recent PCAOB standing advisory group announcement, I'm sorry, that's for those of you not familiar with it, that's the regulator of audit firms in the US, has defined what an investor is to be this old-fashioned, someone who pores over financial statements, as opposed to someone who wants to improve the market and therefore might consider how does an accountant take into account things like climate change. And so I do think that this is somewhat at odds, not with MPT diversification, as Jim said, but with the fact that it is viewed as you only act within the financial markets. I absolutely agree with you on income inequality. Just putting on a citizen's hat, I think it is destabilizing to democracies, it's destabilizing to the world, it drives authoritarianism, it drives resentment, it drives violence, in addition to straight up poverty and other things. In some ways, this is the perfect handoff back to Delilah, because one of our initiatives is something called TIFTY, which is an attempt to come up with standards on income inequality. I will tell you that it has been frustrating to me. I have looked at the work that Tip and Mike Musaraka did. I love it, but it is really the tip of the iceberg. And I think that that's the whole purpose of the Predistribution Initiative, is to share more of the returns prior to it making it to GPs and partners, and to share more with workers and investors and society. So I have the perfect opportunity at 12:02 to hand it back to Delilah and say, if that is your concern, then we all have to get more involved with the Predistribution Initiative.
Well, thank you, John, and thank you, Jim, and thanks everybody for your great questions. I know that Damon, we've talked about the task force on inequality related financial disclosures before, and we're long overdue for a catch up. So let's do that. And I want to thank everybody for joining today, for staying a couple minutes over. Please do stay in touch. I agree, Scott. This is, I think it was, wait, maybe it was somebody said that this is a really dense topic, and we need more discussions like this. So we hope to curate that and invite you all back. Thanks again for joining.
Thanks.
So much more
Thank
to
you.
say.